This week, OpenAI took another step toward the biggest IPO Wall Street has ever seen, a debut that could value the company at $850 billion. That's a company with roughly $25 billion in revenue, burning through about $27 billion a year, priced higher than almost every business in American history. And here's the part nobody tells you. Even if you've never bought a single share of anything, this story is already inside your retirement account. So today we're answering the question every investor is quietly typing into search: what actually happens to your 401k if the AI bubble pops? Not the doomscroll version, the real mechanics. How exposed you actually are, what the last great bubble did to ordinary savers, and who quietly gets paid on the way down. Start with a number that should come with a warning label. AI-linked stocks now make up roughly 45% of the entire S&P 500, the highest concentration any single theme has ever reached in the index. The 10 biggest stocks alone are more than 40% of it, an all-time record. And if you own a target date fund, an index fund, almost any diversified retirement account, congratulations, you own them. That's how index funds work. The bigger a stock gets, the more of it the fund buys on your behalf. You never decided to bet your retirement on AI. The index made that decision for you, and the returns show how lopsided it's become. From May of 2024 through June of this year, the S&P 500 gained about 142%. Strip out the AII names, and that gain collapses to 16%. One theme is carrying the entire market on its back. So is this 1999 all over again? Look at the gauges. The Shiller price-to-earnings ratio, the classic bubble thermometer, peaked around 44 in the dot-com era. Today it sits near 41, the second highest reading in 125 years of data. And market concentration is actually worse now than it was then. Here's what the pop looked like last time. From March of 2000 to late 2002, the Nasdaq fell 78%, around $5 trillion in market value evaporated. Cisco, the NVIDIA of its day, the company selling the picks and shovels of the future, lost almost 90% and needed roughly 2 decades to see its old highs again. The Nasdaq itself took 15 years to reclaim its 2000 peak. If you were a saver planning to retire that year, that wasn't a dip. That was a lost decade and a half. But, and this genuinely matters, today's giants are not the dot-coms. In 1999, the market ran on companies with no earnings and a dot-com in the name. Today's AI leaders are some of the most profitable machines ever built. Microsoft, Alphabet, Meta, Amazon, and NVIDIA throw off tens of billions in free cash flow. NVIDIA trades near 35 times forward earnings. Cisco peaked at 132 times. Back then, more than a third of tech companies lost money. Today, it's about 1 in 5. So the bubble question isn't whether these companies are real. It's whether today's prices already assume a future so perfect that even great companies can't deliver it. Because that's the trap. Cisco was a great company in 2000. Great company, terrible stock, for 20 years. So run the math on your own account. If AI names are 45% of the index and they fall 50%, dot-com style, that's roughly a 22% hit to the S&P 500 before you count the panic spreading to everything else. Realistically, a genuine AI bust probably takes a standard retirement portfolio down 30% or more because in a crash, nothing falls alone. But here's the part that separates the winners from the wrecked. The damage depends almost entirely on when you need the money. If you're decades from retirement and still contributing every paycheck, a crash means your automatic contributions spend years buying shares at clearance prices. The people who got destroyed in 2000 weren't the young savers. They were the people who retired into the crash and had to sell at the bottom, and the ones who panicked, went to cash, and never got back in. Which brings us to the uncomfortable question: who gets paid when a bubble pops? Short sellers first. The investors betting against the hype collect on the way down. Cash-rich buyers second. In 2002 and again in 2009, the people holding boring assets, bonds, cash, dividend stocks, got to buy the future at 90% off. Amazon fell 94% in the dot-com bust. Anyone who bought the wreckage and simply held became wealthy. And quietly, the biggest winner of all is the disciplined dollar-cost averager, the person whose 401k contribution buys automatically every 2 weeks, bull market or bust. Bubbles transfer wealth from the impatient to the patient. Every crash in market history has been temporary. Every recovery has been permanent. The only people that isn't true for are the ones who are forced or frightened into selling at the bottom. So what do you watch from here? 3 things. Watch whether AI revenue starts catching up to AI spending. The giants are pouring hundreds of billions into data centers that eventually have to pay for themselves. Watch the circular deals. Chip makers lending money to their own customers so those customers can buy more chips is exactly the kind of financing that shows up late in a cycle. And watch breadth. The narrower the market gets, the more fragile it becomes. None of this is financial advice. It's the map, not the marching orders. But here's my question for you. If the AI bubble popped tomorrow, would you buy the dip or run for cash? Tell me in the comments. I read all of them. And if this helped you see your own money a little more clearly, subscribe to Mind Blitz. We break down the biggest moves in AI and money every single day. And for the other side of this story, watch our last deep dive. DeepSeek just raised $7.4 billion to break NVIDIA, the challenger that could be the pin that finds this bubble. I'll see you in the next one.